This is Robert Kraft, and I'm your host for SNN.Network. And with me today is Mr. Michael Corbett from Perritt Capital Management. Mike, welcome back to this Wall Street View.
Great. Thank you for having us.
It's great to have you as always. To start, let's get your background and really what led to where you're at today.
Oh boy, I feel like an old man. I know a lot of guys have been doing this a long time too, but this is 30 years now that I've been doing this. So I started with Dr. Perritt, who founded the firm. I actually started as a newsletter writer and then founded the Perritt Capital side in 87, 88, and I joined him in 89, 90. So, and it really was just right out of college. I actually started as an intern with him, and it was other professors at DePaul University where he taught. So he was never my professor, but I had known a bunch of professors who knew Dr. Perritt and said, go talk to Dr. Perritt, he'll give you an intern. Next thing I know, I became his right-hand man. And I started out really in the newsletter side of the business because he had a newsletter in the 80s and in the 90s, and then started getting into the money management business. So I spent the first 8 to 9 years of my career with him writing newsletters, really about mutual funds, no-load type of mutual funds, and then also a newsletter which was called Investment Horizons, which was basically a microcap type of newsletter. So that's kind of where I cut my teeth on the whole stuff, and then started helping Dr. Perritt with the money management side, and then he gave me the reins in 1999 as the lead manager for all the microcap portfolios, and then he retired in 2010-11 is when I bought him out. Stuck around for about a year, and then unfortunately, one of the things I'm mourning is he passed away last year. So
I'm so sorry.
The guy that helped me out is no longer with us. So, but I can continue to run his firm and continue and enjoy the microcap world.
Well, first, let me offer my condolences. I'm so sorry for his loss, and you're definitely flying the flag. That's for sure.
Yeah. Yeah.
So I had you back on the podcast back in May 2016, episode 20.
Wow.
I guess, in podcasting world, I think that's equivalent to the 30 years of investing world. But
sure.
I digress. But for those who may have missed our interview on there, can you briefly discuss Perritt's investing philosophy and process?
Sure. It all starts obviously with microcap, and some people have different definitions of what microcap is. I think in the world that you and I circle in, understand microcap is really a couple hundred million market cap or less type of thing. I've seen a lot of them where they think it's $1 billion or less, which I don't understand that. But anyway, we basically have two products that we run, sort of an ultra microcap that we call, and then a traditional microcap. So for us, it starts with companies below about 500 million market cap for the traditional microcap, and then under a couple $100 million for the ultra microcap, and really kind of keeping a focus on our portfolios of having the median, their average market caps at levels that really kind of hit the sweet spot of microcap. So to us, with an ultra microcap, that's companies below 100 million market cap, and then with the traditional microcap, it's kind of a 150, 250. Somewhere in that range in terms of microcap. So that's the first part that we started, make sure that we're looking at companies like that. From the real meat of the process, we're kind of looking at 3 different quality measures in the way we view it. First is the quality of financial statements. So we look at all the companies in the space and want to find companies that have strong balance sheets. And if they have debt, that's okay, but we want to make sure that we have strong cash flow to support those debt levels. So we actually use a 9-factor model, which is the Petrovsky score. Some people know that, but it basically is made up of 9 items that you can get off of the 3 financial statements. And if a company is scoring at least 6 to 9 on that, moving sort of in the right direction, then we consider to have quality. From there, the next step really is digging into the company's product, service, management. We want to find companies that have interesting niches, something that they can survive and compete with, and then management teams that just really know what they're doing, have great background, have skin in the game, all the other kinds of measurements. The last one, I don't know if it's necessarily quality, it's just that we tend to have a value bias, so we make sure that we're not paying too much for businesses. So we're looking at various valuation characteristics and try to buy it at a discount to what we think the intrinsic value or the value of the business is in the future.
Gotcha. And also, I have to ask for both funds, how do you go about portfolio construction? Do you have a certain way in which that you weight certain things versus others? How does that work?
It really is starts with bottom up. So we're just trying to find great business, but we certainly do look over our shoulders from the standpoint of how industries come together. But positions start from 0.5% to 2% on the top end, and then let them grow from there. And if you get to 3-4%, if they grow to that level, then that's something we watch and maybe cut back. But we don't have any hard rules from the standpoint of industries. I will tell you that when we get to 25 or 30% in one industry, it's something that we ask ourselves every day. Okay, why are we so heavy in that? Is that still appropriate? And why aren't we finding other values in those other industries that are represented?
And also, because for those, just like you said in your opening, I mean, Perritt Capital's been around for a very long time now. It's a known name in terms of microcap funds. So, I mean, at this point, I would assume that your portfolio it's tough to be concentrated. Right?
Oh yeah. Yeah, it certainly is. I mean, it all comes down to, liquidity, because you have to certainly view that. So concentration's not horrible, but if you're trying to run several $100 million like we do, it can be tough from the standpoint of getting too concentrated in very thinly traded stocks.
For sure. Okay, so now to the meat and potatoes of our interview, because the whole reason that we wanted to do this today is when we last saw each other at the MicroCap Leadership Summit in Chicago, at one of the networking events, we were talking about this topic of the new accounting rules on lease agreements. So for my audience that may not have heard about what the FASB put out there, what exactly are these new changes?
Yeah. So for those who want to dig deeper, they can go to FASB. .gov and dig into the rule relating to operating leases, but it basically is a standard that FASB put together. It's actually put together in February 25th, I think, 2016. It's ASC 842, and basically what it is companies are publicly traded companies. We can talk about private companies later, but publicly traded companies starting this year are required to put operating leases on their balance sheets. So if you think about it, it's kind of been like an off balance sheet type of item. It's always been a debt. I mean, most leases are related to the office space. It hits the retail market in a bigger way because a lot of retailers, they rent lease those brick and mortar spaces. So basically, what you have is you have four items that are on the balance sheet, and on some companies it may be grouped together, but generally they're supposed to put it on there as a long-term operating lease liability. But then if it's less than a year, then there's a short-term operating lease liability. But then if you remember any of your accounting, and I am no CPA, so I have plenty of accounting classes, and I know enough just to be dangerous. But if we're going to put a liability on there, where's the asset? So the asset on the other side is an operating lease right to use asset. So it goes in terms of long term, and then obviously is short term. And as they run through the lease, both items get reduced by those amounts. So then the balance sheet obviously balances debt to assets, as if you remember any of your accounting out there. So but the point is that now it has to go on there, and now debt looks a lot more egregious on some companies, more on others. The bottom line is that debt levels went up this year for a majority of companies, particularly when you go and look at a retail type of company. It's in some cases it's mind blowing in how much is on there. But it's always been there before, but we've never really seen it on the balance sheet. You're aware of it, and I kind of think that it is debt, So I mean, that's sort of the debate of like, okay, is it part of enterprise value when you're valuing the company? And my general thought is yeah. So, but like I said, feel free to dig into more of it. Ask a CPA more questions to understand how it all works. But it's somewhat basic from the standpoint it goes on the balance sheet now.
For sure. Well, Mike, let's. I don't know if you have an example that you can think of off the top of your head, just to kind of demonstrate, let's say, all right, here's a balance sheet from when these rules weren't in effect versus now here's what the balance sheet looks like with the rules in effect and how that can impact your calculation that you're making. Can you think of one off the top of your head or a quick example?
I didn't bring one with me from a standpoint of pulling together, and I don't have a lot of retailers, but I can tell you that, someone, a company like, it's kind of interesting, a company like Walmart, you can definitely see that their operating lease liability, did go up by several $billion. I don't know the exact number, but it's not as big for them because they do own some of the stores. But then you go to someone like a Macy's, and there's more leases there, and their number really skyrocketed. And it just, sometimes I wonder, and I look at that and I go, well, Macy's stock has done horrible, but there's other issues going on there with that. And certainly that's not our space, but you see that those debt levels just take off, and it's like I said, it's not just retailers. There's plenty of other companies where they have office space, whatever, so they have to put that on the balance sheet too.
So just to be clear, to maybe simplify it, if I were, especially being the novice that I am as well, really what this has to do with is that with these new rules, now that you look at the balance sheet, you're probably going to see debt levels rise for a company that you probably knew that off balance sheet, those debt levels were probably at that level, but now it's actually written on the balance sheet, correct?
Right. That's exactly what it is. So you'll certainly see higher debt levels across the board. Mm-hmm. In an environment where debt has been growing immensely for a lot of companies in the last several years, rightly so in my mind, because interest rates at near zero levels.
Yeah, I was just going to ask, what was the reason? Why did they put this in now?
That's a great question. I really didn't dig into that level of why. The only thing I can surmise is
more transparent.
It is a debt level, so it should be just making sure investors are more aware of the debt. It's transparency.
Yeah. So you also mentioned during this conversation that another interesting part of these changes is now you're including this new debt level in enterprise value. What did you mean by this, and should we be including and are others including this as part of their calculation for enterprise value?
So the simple answer is yes. If just back to sort of education of things, enterprise value basically is defined by market cap plus your net debt. So if a company has $50 million in cash but $100 million in debt, then you need to add another $50 million to your market cap to come up with an enterprise value level. So obviously now the enterprise level would be higher now, given with these operating leases. So to me, that's the most important part of this from an investor standpoint, is understand that is part of the calculation, and whether others are using it or not, I don't know. I can see that on a lot of databases that it is in some cases, but then when you get down to the microcap world, it's never accurate all the time, because I've come across several companies when I pull it up on systems like we use Capital IQ. And even go to the other basic ones, whether it's CBS MarketWatch, Yahoo Finance, whatever it is. Sometimes they don't pull up the things accurately. Even Cap IQ doesn't get everything accurate, so we always have to sort of back into it, make sure that they're calculating it properly on that. So and at the end of the day, that's a bigger part of how we value companies today, mm-hmm. is whatever the enterprise value is, and then relate that to EBITDA or cash flow or whatever metric you want to use.
So let's say, because these are new rules and maybe a lot of these companies are just going to be enacting these changes in a future earnings. How were you doing this previously with being able to find these off balance sheet lease agreements and then putting that into your calculation?
Well, the answer is what most of us weren't. so because it was part of, in a sense, the income statement side, because it was an expense. So you were seeing, so you could. That's in a sense you were valuing it that way because you're just valuing it based on the earnings that they were getting or the cash flow that you were getting. So you could certainly should be aware of that. But it is an interesting question from the standpoint of enterprise value. In a sense, was not. You could argue that was not calculated appropriately in the past because we weren't putting these type of numbers into the calculation.
And Mike, real quick, you also mentioned a couple names in there. Just have to ask: Walmart, Macy's, shareholder, not shareholder?
No, not a shareholder.
Okay. And also, I'm going to call you Bam Bam for the rest of this interview because you keep hitting the
bouncing down. I talk with my hands. I can't. I'm not Italian, but I do talk with my hands.
I was going to say that must be a Chicago thing.
Yeah, I think so.
So we kind of, you more or less already answered my next question, but kind of just get a recap. I mean, how would you say these new rules affect your calculation for a company's enterprise value?
Well, the answer is to make sure that you're, digging in deeper and make sure that the enterprise value is calculated appropriately, and that you're setting your appropriate valuations going forward, and what you think the multiple should be related to that type of calculation. But I mean, it's an interesting world because it's one of the things I will tell you that has changed a lot. Is back in the when I first started in this business, we used PE ratio to value things much more so 20, 25, 30 years ago. And you still look at that, but it's become more important to use multiples of EBITDA and free cash flow, and then using that back to the market cap or more appropriate the enterprise value type of number. That wasn't used as much 25 years ago, and that's why it's much more important to make sure we have the enterprise value calculation done appropriately.
Well, why the change now? Why is there more focus on enterprise value now versus way back when? Not way back when. Now I didn't mean that as a dig.
That's okay. Old man. Hey. I think the simple answer to it, there's a lot of parts to it. I think the simple answer, though, is that the E in PE can be hard to understand or manipulated in a way. There's a lot of things that go into an E, so that aren't part of the business. It's the two things you can't really sort of manipulate in a sense are whatever the total revenue is of the business, and then what the actual cash flow is. So that's if they're manipulating those numbers, then there's fraud. That's a whole nother story. But that's the bottom line, is that from accounting standpoint and accounting practices, E can be pretty different from one company to the next, and then it just becomes a difficult thing to compare apples to apples from one company to the next, from industry to the next, to market to the company and so forth.
Right. So you also, I'm doing a little transition here, because you also just published your third quarter commentary, and you write briefly about a topic that's been really discussed at length. And I'm actually going to be doing another interview on this topic very shortly, but I wanted to get your 2 cents on it. And the quote being, "The prevailing thought has been that growth will continue to be the place to invest because value is obsolete," end quote. Why is it that this time is different? The mantra you use is the this time is different mantra not apply here.
Yeah, that's a tough one. There's two parts of the sorts that sort of explain that, and one is, we already talked about it a little, which is enterprise value to EBITDA and cash flow. So, what I mean by that is when the traditional way or the old way, back to this old man way, the way we would define value, and this goes to big institutions like State Street, Vanguard, you name it, would basically, okay, how do you separate value from growth? And that old way was price to book. So you would just you take like the S&P 500, you take the Russell 2000, whatever it is, and you would separate. This is what they did many, many years ago. They would separate the price to book companies and say, okay, those of the S&P 500, those 250 are more growth and those are more value because their price to book number is higher and these are lower. You can't do that today because book value is negative in a lot of instances with companies. And it's because companies are running, and like we're back to it's an interest rate phenomenon. With interest rates incredibly low, it makes sense to borrow more money and buy your stock back, pay, whether they're paying dividends or whatever. But it just makes more sense to run your businesses more on cash flow, and that's what's going on. I mean, there's a lot of other parts to it, but that's sort of the first part of it of what's going on. So then, using an old traditional way of separating value is tough. So that's sort of our statement there is like, I can't use that anymore. In fact, we've actually dug into some of the traditional, like Vanguard has a large cap value and a large cap growth. And we dug into their portfolios and found they own the stocks in both portfolios. Like, wait a minute, how can it be in both? And it's just because they haven't transitioned it, whatever, in that way. And then their definition has gone out the door. So they're using other metrics that they don't disclose in great detail, but it's related to, enterprise value to EBITDA. And some other in other metrics that they're using. So they're using several different metrics to come up with what is a value stock and what is a growth stock. So it's just really tough to today. It's not as easy just to define what value is and what growth is.
I mean, would you say it's tough right now? I mean, we're seeing markets at all-time highs. I mean, it's almost everything that's a good quality business is probably trading at, I don't even want to say a metric, but it's a multiple X of what it was trading, let's say, during downturns, So, I mean, this idea of, value is dead, and value investing has gone out the window. I mean, is it because we've just seen all-time market highs and eventually markets, it's always cyclical. It's going to go back down. And that's when you're going to start to see some of these more value names, traditional value names actually become cheap.
Sure. Well, first off, I'm not saying value's dead. I agree.
I agree with that 100%.
I'm just saying it's incredibly difficult,
right,
to define it today, because of how it's changed so much and how companies operate their businesses, and appropriately so. They should be running their businesses like they do with buying stock back and so forth. So it's just what is the rule of law, or the new rule of law of how you define value and growth. Mm-hmm. We tend to think it's more related to price to sales and then price to EBITDA. Mm-hmm. So breaking it down that way makes us feel like we're more on the value side, because when I look at our portfolios today, we trade at less than 1x sales, where the large cap market is at like 2.5x sales. That's just all of the stocks together. And then if you look at a Russell MicroCap or a Russell 2000 benchmark, you're close to 2x. And then when you come down to price to EBITDA, you're well into the double digits when you talk about S&P 500 companies, as well as even the indexes, where our portfolios are kind of in the low double digits to a single digit type of multiple. So that makes me feel that at least I'm still doing the value side of our approach to investing. But you picked up an interesting one, Bobby, from the standpoint of what we talked about in our commentary, because it's a tough one with how you define value, and that's why we mentioned it.
For sure. And to be clear, I agree with you. I don't think value is dead. I don't ever think value investing will be dead. But as one of our authors in the next issue of the magazine says, it's a nuclear winter.
Oh, I like that.
Yeah, I thought that was pretty good too.
Yeah.
So, Mike, with that, where can my audience go and find more information about you and Perritt Capital?
It's real simple. If you just go to our website, which is just perrittcap.com, and that's spelled PerrittCap, and you can learn all about Perritt Capital and our various services.
Mike, thank you again for joining me today. I always appreciate it.
Great. Thank you.